Securing your future, investing in T-bills and government bonds. Welcome to this inspiring guide on investing in Treasury bills, T-bills, and government bonds, two powerful yet simple tools to help you take control of your financial future. Whether you're starting your retirement planning or enhancing your investment portfolio, this video is designed to equip you with everything you need to know about these low-risk options. By the end, you'll feel confident, motivated, and ready to take the next step toward financial security. When it comes to preparing for retirement, safety and stability are key. That's where Treasury bills and government bonds shine. Unlike riskier investments such as stocks, these government-backed securities prioritize protecting your wealth while providing steady returns. They are perfect for those looking to safeguard their savings and create a reliable income stream during retirement. Investing in T-bills and bonds also adds a layer of diversification to your portfolio, helping you manage risks while balancing long-term growth with short-term stability. Let's explore each of these investments in detail. Think of T-bills as short-term loans you give to the government that mature in less than a year. When you buy a T-bill, you're essentially lending money to the government in exchange for a promised return. The best part? T-bills are backed by the government, making them one of the safest investments available. Unlike traditional bonds, T-bills do not pay periodic interest. Instead, they are sold at a discount to their face value. For example, you might purchase a $1,000 T-bill for $950, and when it matures, you receive the full $1,000. The $50 difference is your profit. The main advantage of T-bills is their security. Since they are backed by the government, the risk of losing your investment is extremely low. They are also highly liquid, meaning you can easily convert them into cash if needed. This makes T-bills an excellent choice for individuals who want to keep their savings stable while planning for larger financial goals, like retirement. Because of their short-term nature, T-bills are ideal for those looking for quick returns without having to worry about market volatility. They offer a straightforward way to grow your savings while minimizing risk. Buying T-bills is easier than you might think. The most common way to purchase them is through platforms like Treasury Direct, which is run by the U.S. Department of the Treasury. Alternatively, you can buy them through banks or brokers who specialize in government securities. When purchasing, you'll choose the face value and maturity period that fits your financial needs. After completing the transaction, you simply wait for the T-bill to reach maturity and enjoy your risk-free profit. While T-bills are a very low-risk investment, it's important to consider their relatively modest returns. Since they are short-term investments, they may not generate as high of a return as other options, such as stocks or long-term bonds. However, their unparalleled security and simplicity often outweigh this limitation, particularly for retirement-focused investors. Moving on to government bonds, these are essentially long-term loans to the government that come with regular interest payments, called coupon payments. Unlike T-bills, government bonds can have maturities ranging from 1 year to 30 years. When you invest in government bonds, you're not only safeguarding your wealth, but also earning interest over time. This makes them an excellent choice for generating a steady income stream, which is vital during retirement. When you purchase a government bond, you agree to lend the government a specific sum of money for a certain period. In return, the government pays you interest periodically and repays the principal amount when the bond matures. For example, let's say you purchase a $1,000 bond with a 10-year maturity and an annual interest rate of 3%. Every year, you'll receive $30 in interest, and at the end of the 10 years, your original $1,000 is returned to you. One of the biggest benefits of government bonds is their ability to provide stable, predictable income. This is especially important for retirees who rely on consistent cash flow to maintain their lifestyle. Government bonds also offer security, much like T-bills. Since they are backed by the government, your risk of losing money is very low. Additionally, government bonds are an effective way to preserve capital while combating market volatility. There are several types of government bonds to choose from, each serving specific financial needs. Treasury bonds, for instance, are long-term securities with maturities of 20 to 30 years, offering higher returns for those willing to invest for extended periods. On the other hand, inflation-protected securities, such as Treasury inflation-protected securities, TIPS, are designed to protect your investment against the eroding effects of inflation. These bonds adjust their principal value based on changes in the Consumer Price Index, CPI, ensuring your purchasing power remains intact. Like T-bills, government bonds can be purchased through Treasury Direct or financial institutions such as banks and brokers. You'll need to choose the type of bond and its maturity period based on your financial goals. Once purchased, you'll receive periodic interest payments until the bond matures. Now that we've covered the basics, let's compare T-bills and government bonds side by side to help you decide which is right for you. T-bills are short-term, offering liquidity and flexibility. They're great for those who want quick, low-risk returns without committing their money for long periods. In contrast, government bonds are long-term investments designed for steady income. They're ideal for retirees who need reliable cash flow over decades while preserving their principal. Choosing between T-bills and bonds ultimately depends on your timeline and financial goals. For most retirement plans, a mix of both can provide an effective blend of short-term security and long-term growth. Both T-bills and government bonds play crucial roles in retirement planning. They provide a foundation of financial stability that other investments, like stocks and real estate, can build upon. By allocating a portion of your retirement savings into these low-risk securities, you create a safety net that ensures you always have access to funds when needed. This helps balance the potential ups and downs of riskier investments while ensuring long-term peace of mind. Diversification is a cornerstone of successful retirement planning. By spreading your investments across various asset classes, including T-bills and bonds, you reduce the impact of market fluctuations on your portfolio. While stocks might offer higher returns, government-backed securities act as your safety anchor, keeping your finances grounded even during turbulent times. While T-bills and bonds are excellent for protecting your principal, it's important to consider inflation's effect on your returns. Over time, inflation can erode the purchasing power of your savings, making it essential to integrate options like TIPS into your investment strategy. By including inflation-protected securities, you ensure that your retirement savings keep pace with the rising cost of living. Understanding bond yields is crucial for making informed decisions. In simple terms, the yield is the effective return on your bond investment. It's calculated by dividing the bond's annual interest payment by its current price. For instance, if a $1,000 bond pays $50 annually in interest and its market price is $900, the yield is approximately 5.56%. Keep this in mind when comparing bonds to other investment options. Most T-bills and government bonds are subject to federal taxation, but exempt from state and local taxes. This can make them more tax-efficient than other investments. Additionally, consider holding these investments in tax-advantaged accounts like IRAs to further reduce your tax burden. While T-bills and government bonds are among the safest investments, they are not completely risk-free. Interest rate changes and inflation can impact the value of your returns. Being mindful of these limitations and balancing your portfolio with diverse assets can mitigate these risks effectively. Many retirees owe their financial security to smart investments in T-bills and government bonds. By following disciplined strategies and focusing on stability, they've been able to enjoy their retirement without financial worries. Stories like these remind us that a strong financial foundation is achievable for anyone. To begin, assess your financial needs and retirement goals. Then, research the options available on platforms like Treasury Direct or consult a financial advisor. Start small, purchase either a T-bill or bond, and gradually integrate them into your portfolio. Avoid over-relying on a single investment type or underestimating the impact of inflation. Diversify your savings, keep your goals in mind, and seek guidance when needed. Platforms like Treasury Direct and investing apps make buying T-bills and bonds simple and accessible. Financial advisors can offer personalized guidance tailored to your unique needs. Don't stop at T-bills and bonds. A diversified retirement portfolio should include a mix of government securities, equities, and other investment options to balance growth and stability. Remember, every small step you take today brings you closer to a secure, comfortable future. With patience and discipline, your financial goals are within reach. Now's the time to take control of your financial future. Start exploring T-bills and bonds today and begin your journey toward a stable and fulfilling retirement. Thank you for watching, And here's to building the financial future you've always dreamed of.